we'd like to welcome you to today's program. We're going to talk about managing service provider risks, and appreciate you tuning in today. We've been doing, being Mary Beth and I, have been doing a lot of programs recently on the brand new stuff coming out on Reg Z and RESPA. So it's kind of nice today to go back to something that's pretty much tried and true and settled, instead of trying to figure out what does this stuff mean. It's brand new. So appreciate you going along on the journey with us today. Examiners, of course, are pounding banks on a lot of different areas, but one of the areas that they do focus on is having a compliance management system dealing with third parties. And folks, when you look at different laws and regulations, there's a lot of laws and regulations that touch on the issues of having third parties do your work. You know, we have found out the hard way when some banks that regulators will beat you up over fair lending. And you're going, but we didn't do anything wrong, but you work with the third party that did something wrong. Those of you in IT exams have been beat up over a deficiency that your provider has. So, you know, bottom line, all of you are responsible for things that are done by the third parties that you're engaged with. Some of our consulting clients had talked to us a good while back about putting together some materials for them, and those materials are the basis of today's program. So, you know, we have sample policy, procedures, risk assessments, checklists, and all that good stuff that will be included in your material. So I hope you printed them out, because we're going to be following them pretty closely. On page number 1, we talk about introduction here, that, you know, using a third party can be a very appropriate business decision for the bank. You know, sometimes you want to get into a line of business, but you don't have the volume to support it yet, but you can work with a third party that can provide those things. And then as you grow into them, bring them back in-house. Sometimes you just flat out don't have the expertise needed to maybe offer a particular product or service, but a third party can provide that. So, I mean, there's a lot of good reasons for doing it, but we can't lose track of the fact that just because you got a third party doing the work, you remain responsible for assuring that everything's being done in a safe and sound practice, being done in compliance with all the laws and regulations you have to comply with. So, and again, there's plenty of good reasons for doing it, but don't lose sight of the fact that you got to manage it. What we're going to try to get you through today is an effective process for managing the risks related to third-party service providers. If you look at our goals down at the bottom of the page, we're going to talk about doing due diligence, particularly when you're selecting a provider up front. We're going to talk about policies, procedures, controls, all that good stuff. We're going to talk about things you should consider including in your contract with a third-party service provider, monitoring that needs to be done, and, you know, type of action you might need to take when you find a problem in the monitoring area. Over on page 2, there's actually a variety of laws, but we're focusing largely on some information that came out of Graham-Leach-Bliley Act. There's a blast from the past. We also talk here about what this program is and is not. Again, we're trying to help you build a process for managing third-party service providers. We're not doing a review of the detailed rules that you need to worry about under identity theft red flag rules, and all the things that you need in information technology. We're talking about the third-party relationships in general. There's other programs we could do delving into just some of those other aspects. So this is the big picture. The process is what we're trying to do. We give you the agency's websites there on page 2 as well. Over on page 3, we talk about the guidance. And various federal agencies have put out guidance on third-party risk management. In my opinion, the most comprehensive guidance is the Financial Institution Letter the FDIC produced. It's FIL 44-2008. And, of course, that 2008 indicates it came out in 2008. Folks, other regulators refer to this document. It's just kind of the total source. And what we have in this manual is based on the guidance out of FIL 44-2008. We have a definition here of third party, and folks, there's several things in here that are critical, but the most critical part is that the term is defined broadly to include all entities that have entered into business relationship with a financial institution. It doesn't matter if that other institution is a bank or a non-bank, whether they're affiliated to you or not, whether they're regulated or non-regulated, whether they're domestic or foreign. It's all entities. Now, folks, obviously, we and the examiners get more excited about this when the relationship is absolutely critical of your survival, something like core accounting services. You know, you couldn't operate more than a day or two without your core accounting services. Got to have them. Absolutely critical. But then you have contracts, too, with, you know, somebody comes in periodically and washes the windows in your branches or cuts the grass at your offices. You know, if that person, the relationship fell apart, one, you could find a substitute probably overnight. You could probably go for a week or two or months maybe without having those services. They're just not critical. But yet the guidance applies to everybody. Now, obviously, you're not going to have a 30-page contract with the guy that cuts your grass at the branches. Probably won't even have a contract. But you might, because you might want to talk with them about things like liability issues. You know, they've got to have some protection. If somebody gets hurt on the job, you want them to have insurance coverage to protect their employees. I mean, there's issues to be dealt with there. So, anyway, it's any entity, okay? We also talk a little bit about why to use them and touched on them earlier, but, you know, you might be able to make products or services available that you don't currently offer and you couldn't easily offer. You know, those are reasons why you might want to get into a third party. You might get into arrangement with a third party that already has the product and service. You just kind of jump on board and make it available to your customers. You can also get involved because it's something new, okay, or it could be something you've done traditionally in-house and you want to move it out for a variety of reasons, such as you can do it cheaper by using a third-party provider. We talk about the benefits down at the bottom of the page. This can help you meet strategic objectives, either by bringing in more revenue, reducing costs. This can allow you to have greater expertise or efficiency for a particular activity. Again, a lot of good reasons, a lot of good benefits from these relationships. As we discussed earlier, you cannot lose sight of the fact that even though you've got a third party doing the work, you're still responsible. So on page 4, we talk about the responsibility of your board and senior management. Folks, they got to make sure that these activities are conducted in an appropriate fashion. Third-party providers got to comply with all the laws and regs. They got to take care of your customers. You know, and they got to perform as well as you would perform if you're doing this task yourself. Down at the bottom, we talk about an overview of the guidance, the FDIC's FIL 44-2008. We're going to talk here in a moment about potential risks that exist in third-party relationships. We're going to point out that this applies to any relationship. We'll give the guidance includes a framework for your board and senior management on things they need to do with oversight and risk management of significant third-party relationships. And, folks, if it's not a significant relationship, then you just whittle away at some of the things that are required. You know, you're not going to do everything for the guy cutting your grass that you do for the core accounting software provider. So, but again, the framework's there that'll work for everybody. Over on page 5, we keep talking about a significant relationship. So, you know, what makes a relationship significant? Well, according to the FDIC, there are several things. You know, if it's a new relationship, you never worked with these guys before, you know, it's significant just because it's new, an unknown factor. Now, once you've worked with them a while, if it's not a critical relationship, then, you know, it's not all significant anymore. If you're implementing new activities, new products, new services, that makes it fairly significant. You've never offered this before. So just the fact that it's new is important. Anything that's going to have a material effect on your revenues or expenses, okay, that's got to be significant to hit your bottom line. When you got a third party performing critical functions like core accounting, when the third party is storing, accessing, transmitting, or performing transactions on sensitive customer information, just the fact they have access to your sensitive customer information makes the relationship significant. When you have a third party that's directly marketing your products or services, your reputation's on the line. It's pretty significant. When you have a third party providing a product or service that involves subprime lending or card payment transactions, folks, those are, you may not engage in them at all, but if you do, just the fact you're engaging those activities, something like subprime being something that may be viewed as abusive of customers, it's a kind of a questionable product to be in anyway. You got a third party doing it, extra monitoring would be important there. Anything that poses a lot of risk to your earnings or capital, those would be significant. Bottom of page 5, we talk about regulatory oversight, and I mentioned earlier examiners look at this in their exam. And folks, your management of third-party relationships, they look at it in just about every type of exam. Comes up in compliance, comes up in safety and soundness, information technology, kind of everywhere across the board they're looking at this. It's a part of their normal examination process. Look at the last bullet on page 5. This is somewhat significant item. We point out that while you may properly seek to mitigate the risk of the third-party relationships through the use of indemnity agreements, okay? They agree to indemnify you if they do anything wrong and you have a loss. Folks, you want to try that. You want indemnity language in your contract, and it's great if it works. But the FDIC points out here that those agreements do not insulate your business from the ultimate responsibility for conducting the bank and related activities in a safe and sound manner and in compliance with the law. All right.